Good morning and welcome to another week of Business Morning. I'm Chimeze Obi Iwago. Happy new month. Oil prices fell this morning on worries over China's economy after a survey showed factory activity growing at its slowest pace in 17 months. In the world's second largest oil consumer, concern compounded by a rise in oil output from OPEC producers. Brent crude oil futures fell 81 cents to $74.60 a barrel, while U.S. West Texas Intermediate crude futures dropped 69 cents to $73.26 a barrel. China's factory activity expanded in July at the slowest pace in nearly a year and a half as higher raw material costs, equipment maintenance, and extreme weather weighed on business activity, adding to concerns about a slowdown in the world's second biggest economy. Also weighing on prices, oil output from the Organization of the Petroleum Exporting Countries rose in July to its highest since April 2020 as the group further eased production curbs under a pact with its allies, and top exporter Saudi Arabia phased out a voluntary supply cut. While coronavirus cases continue to climb globally, analysts say higher vaccination rates would limit the need for the harsh lockdowns that gutted demand during the peak of the pandemic last year. In the meantime, a major highlight from Tuesday's briefing by Governor of the Central Bank of Nigeria, Mr. Godwin Emefiele, on the outcome of the Monetary Policy Committee is that it will no longer be business as usual for bureau de change operators in the country, as the Apex Bank has discontinued the sale of foreign exchange to them. Since that announcement was made, a lot of reactions have followed it, with many analysts suggesting liberalization of the foreign exchange market as a lasting solution to the problem. Let's watch this.
The central bank will henceforth discontinue the sale of foreign exchange to bureau de change operators.
This can be described as one in a million announcement that roiled the financial markets this week. For the central bank, this move became necessary following what it described as unscrupulous activities by the bureau de change operators. Following the advent of COVID-19 and its unintended effect on global oil prices, Nigeria's external reserves saw a heavy decline, with many foreign investors withdrawing their funds. This created a huge liquidity problem in the FX market.
You are not only talking about accessibility, you are even talking about cost. You know, the product that we cost at 360 naira for $1, we have to pay back now at 520 naira, for $1. That is even if you get it.
Considering the weighty allegations against the BDCs, Channels Television reached out to the association executive, but they would neither pick nor return the calls. However, we went into the streets in Lagos to find out. These individuals operating on the street are not necessarily licensed operators. While they're reluctant to talk to us on camera, we did find out that most of them carry out their activities under one BDC licensed operator.
Okay, so that means the bureau de change will go to the bank. Then from the bank, they can still operate.
Those who are traveling?
Yes, can go to the bank to collect that PTA or BTA. Okay.
In this circular released by the central bank to promoters of BDCs and all deposit money banks, the regulator is refunding BDCs with pending license applications their minimum capital deposit of 35 million naira and licensing fees. The Apex Bank also directed deposit money banks to set up a designated desk to serve FX customers.
The very problem that we accuse the BDs of will now be translated now to the banks. Those problems will still continue to manifest. Those who are on that desk, they are not angels, they are human beings. And for as long as you have these opportunities, those abuses will still continue.
For many, the permanent solution to this challenge is liberalizing the market in order to attract foreign investors and increase forex supply.
They had to put the appropriate structures in place to encourage or to stimulate Nigerians exporting more goods or producing more of the goods that are currently imported, so that we can better have a stronger international balance of payment or international trade position.
You need to liberalize the rate at which people can bring in their supply. If you are imposing a rate of 410 on the export process, on foreign direct investors, on the embassies, on the oil companies, you are discouraging them from bringing in the foreign exchange into the economy.
For now, the problem in the FX market remains until the central bank finds a lasting solution to the liquidity challenge. In the coming weeks, market watchers forecast that the decision by the CBN will lead to a depreciation of the naira. However, for the week ended July 30th, the value of transactions in the I&E market was up over 80% to $590.34 million. The NAFIT went up slightly, 0.02% to 411 naira 18 kobo for a dollar, while the BDC rate ended lower, 2.40% at 512 naira for a dollar. Ini John Mekwa, Channels Television News.
And also last week, the International Monetary Fund in its World Economic Outlook for July 2021 titled Fault Lines Widen in the Global Recovery retained its projected growth of 2.5% for Nigeria in 2021, identifying the slow rollout of vaccines as the main factor weighing on the recovery. At its 2021 virtual spring meetings in April, IMF had estimated that Nigeria's economy would grow by 2.5% in 2021 from the 1.5% announced in January. It would also be recalled that in June, the World Bank had raised its growth forecast for Nigeria to 1.8% this year and 2.1% in 2022. Now, the central bank expects the economy to grow 3.15% in 2021, and the federal government sees a 3% growth. How feasible are these growth projections? We are being joined by the Chief Executive Officer of CFG Advisory, Tilewa Adebajo. Good morning, Mr. Adebajo. Thank you for joining us. And Happy New Month.
Yes, thank you. Good morning, Chimeze.
Good morning. Well, the IMF has reiterated their views that 2021 growth for Nigeria will come in at 2.5%. In view of the surge in insecurity and the disruption to the supply chain logistics in Nigeria, do you think that these projections are feasible?
Yes, I think indeed they are feasible, and I think that has been factored into it. The central bank is projecting about 3% growth. So while the economy is growing, I think it's a positive development. But it's important to realize that this is positive growth, but it's growth that is below the rate of population growth. And what the growth that Nigeria needs now to lift it out of its current situation is about 6.5% and above on a sustainable basis to get us out of the poverty trap that we're in, and also our debt cycle.
Now, over the last 48 months, according to the EIU, the average rate of inflation in Nigeria was 13.4%, while other countries with CCC rating had an average inflation of 5.8%, and Sub-Saharan Africa was 4%, oil producers 3.3%. Now, what does this data tell you, and what can we deduce from this data, bearing in mind that the maximum level of inflation in the CBN target is 6 to 9%, while the official headline inflation today is 17.75%?
Well, I think the problem with inflation is very well documented. The key factor driving inflation in Nigeria today is food inflation. And we understand, as you said, with the disruption in the supply chain, the insecurity in the northern part of the country, which is also a very significant source of the breadbasket for Nigeria. So these are the challenges we've had. On top of these challenges, I think we have ways and means financing also that is putting inflationary pressure on the system. So between food prices going up and the ways and means financing, these two factors are what is sustaining a high rate of inflation in Nigeria today.
Now, you talked about for Nigeria, considering our population growth, we should be looking at 6.5% growth. Now, policy is important if we have to achieve the kind of growth that we are talking about. Now, part of the decisions reached last week by Central Bank to stop allocation of forex to BDCs is seen as one policy that will fuel inflation further. What is your take on this decision, and how much impact do you think that may have on price index and even job creation?
Well, let's understand this. The impact of this is zero. The central bank has said very clearly that they put $7.2 billion a year into the Bureau de Change market. So it's not as if the central bank has withdrawn $7.2 billion out of the foreign exchange market. They have just changed the channel. So the supply of the dollar is still the same. So what you see now is speculative panic buying. Eventually the rates will readjust. So the net change of this is zero, because it's not as if the central bank has withdrawn $7.2 billion out of the foreign exchange markets. No, they have just changed the channel. They have changed the channel for that supply from the Bureau de Change to the banks. So as far as I see it, the net effect of that will be zero. What you're seeing now is speculation. People are going to readjust, and eventually the rates will find their level. But I think what is important, and I think what this has pointed out, is the fact that there's a need of convergence in rates between the parallel market and the I&E window. So I think it's important that we develop a dynamic I&E window. We develop a strong interbank market so that we can, and also the banks should be able to simplify the process of applying for foreign exchange. We should be able to do this on an internet platform. Scan your documents into the banks, let them verify it, and let's put a seamless process in place to apply for foreign exchange. If you converge the rates, then I think you'll see a lot more impact on the economy. But the divergence of the rates presents arbitrage opportunities, what a lot of people call round tripping. So you need to close the gap between the official rates and that parallel market.
Now, the major problem in the FX market is the unavailability of foreign exchange to meet demand. So how does this policy solve this problem? And if you were in the shoes of the central bank governor, how would you have handled this?
Well, like I've said before, you need to create a central system. If it's the I&E window and an interbank market whereby everybody goes to buy their foreign exchange from the banks, you can go online into your bank, open a dumb account, your BVN and all your identification has been verified, put your documentation into the system, get registered as a buyer of foreign exchange online. And once you do that, the demand is an issue. There's a certain amount of foreign exchange that the central bank puts into the system every year. But also don't forget that there's about between $25 to $30 billion that comes in from the diaspora. It is these funds also that we need to push in an attractive manner towards an interbank or an I&E window. If we can find that, I think that everybody will find their levels, and I think there should be enough supply once we remove the red tape and the bottleneck, especially for the diaspora funds.
Now, you did mention that this doesn't change anything because the central bank has not stopped the amount of forex that it brings out. Instead, they channeled it to the banks. But if you did listen to our report, I'm sure you heard one of the analysts there talk about also the challenges in the banks, that the banks are also abusing the system. How would you react to this?
Well, like I've said, what the banks need to do is to put in a seamless process to apply for foreign exchange. The central bank itself also has a responsibility to address this issue because why are banks hoarding this foreign exchange? And some people are accusing the banks that they're round tripping. So the banks really also, the central bank has to force the banks to be able to open up in terms of transparency and accountability. I think there was a time where banks used to publish all their allocations in the newspapers. For me, it's not necessary. Let's just get a seamless process in place whereby there's a transparent bid and offer system and we know what exactly the amount of funds are in the system. If you do that, as with everything else in other countries, then you create one single market. It is the inefficiencies of the banking system to be able to process this FX that has resulted in the creation and the expansion of the Bureau de Change markets. But we need one market. We don't need two markets, and we don't need the distortion in two rates. So that convergence And that single window market on a seamless manner is very important. It's not a big deal. I can scan my passport online to the bank. I can register my details online. The bank already has an account with me. My BVN and all my signature IDs are all in the bank. So if I scan in my passport, I scan in my ticket, or I scan in my school fees, bills, or whatever I need to process, the bank should be able to process that money for me and credit my account without me going to the bank. And that's what we need to do.
Now, for most part of the year, the external reserves have sustained the downward movement regardless of the development in the crude oil market. Why are we not seeing the positive impact of the oil demand recovery on the reserves?
Well, you can't see that impact because, first of all, last year, the federal government spent 97% of its revenues to service debt. The NNPC itself has told you that they're having revenue challenges in terms of putting money into the federation account, and that is as a result of the subsidies that they're paying on petroleum products. So there's still a few distortions within the economy, and the structural reforms that we need to make, we haven't made them. So if you don't make those structural reforms, most of your revenues will end up going towards debt service, and that is why there's a challenge with the ways and means financing. So government really needs to stop the ways and means financing because it's a contingency finance. It's not an everyday type finance. And these are the challenges the government has. There's a need for structural reform on the fiscal side because that is really what is dragging the economy down.
And we have seen significant reduction in FPIs and FDI in the country. What can be done to restore confidence?
Well, confidence is the key word. And if the structural reforms in your economy are fundamentally wrong, like people see you are using 97% of your revenue to service debt, the Chinese are even beginning to have some concern about extending additional debt to Nigeria because of our debt profile. A lot of all these things are what people see, that the structural reforms that are needed are not being carried out. So people take a look at your balance sheet and they take a look at the insecurity in the country also, which is the biggest challenge we have in Nigeria today. Who wants to put in their money in a country that is not stable? So there are consequences of all the security issues that we see. And the consequence is what you are seeing that's been reflected in the low numbers of FDIs into the country. The petroleum industry bill, which is a key sector of the economy, is something that has not been passed, and it's been struggling with that for over 10 years. So investment in the oil sector has also gone down. In 1977, we reached 2.5 million barrels of crude oil per day. Today, we're not able to pump out 2 million barrels a day. This shows you the lack of investments in the oil industry. So these are the challenges that we have in terms of the structural reforms and the security situation that does not allow the right amount of foreign direct investments to come into Nigeria.
All right, Mr. Adebajo, a quick one before I let you go. The second quarter GDP data will be released on August 26. Many analysts are of the view that it will be as high as 4.5% because of the base year effect. Please bear in mind that in second quarter 2020, GDP growth was about minus 6.53%. Now, do you share the optimistic view? And if not, why do you differ, and what do you think the growth estimate will be? Also note the PMI, which measures the health of the manufacturing sector, has been declining in the last 2 months. Usually, the PMI is a forward-looking indicator of GDP growth.
Well, thank you very much. I think what is important that I must say is that we're always pleased by positive GDP growth. Because we know that at least at that point in time, the glass is half full because you're seeing growth. But I think it is important because looking at the medium-term economic framework, which defines where the government is going, I don't have confidence in that document at the moment. We also need to also define the fact that our GDP must grow beyond our population growth rate, which is between 3%. So if our GDP is growing at 3%, there's nothing to celebrate. We have over 100 million people in poverty. And the challenge in Nigeria is that we need to set ourselves the standard. The standard is that our economy must grow at least 6.5% to be able to sustain a population of 200 million that we have. If our economy is not growing at 6.5%, then we know that there's some challenges that we have. So I think, yes, positive economic growth without a doubt in the second quarter, but we need to see what policies are we putting in place to look at the structural reforms. If you ask me today, the biggest challenge we have is not GDP growth. The biggest challenge we have is our debt profile. And there's urgent need for structural reforms and to be able to reduce the ways and means financing and to sustain our debt levels, which is now at about 40 trillion naira, which is questioned, which is not sustainable. So the debt profile and the fiscal side is the key challenge for our economy today, not GDP growth.
All right. Thank you very much for sharing your time with us this morning. Thank you, Mr. Tilewa Adebajo.
Good morning.
Thank you. And after the break, we look at some of the corporate earnings posted at the Nigerian Stock Exchange last week. Do stay with us. Last week, we saw a slew of half-year corporate earnings releases: Dangote Cement, FBNH, MTN Nigeria, and so on. Well, Ayodeji Ebo, Head Retail Investment at Chapel Hill Durham, joins us now to x-ray some of these results and what they will mean for the equities market going forward. Good morning, Ayodeji. Thank you for joining us.
Good morning.
Yeah, we saw several companies publish their half-year earnings last week. What's your overall assessment of the results before we go into specifics?
Okay, thanks. Taking an overall view about looking at the results, we saw more positive results than, let's say, flat or negative results. So I believe that part of the improvement in business activities also impacted on this result, because for most of them we saw that year-on-year growth on the top line, and a lot of them also enjoy in terms of backlog of demand as a result of the opening up of the economy. And when you look at the second quarter for last year, it was when it was at the peak of the COVID-19 pandemic, where a lot of businesses were shut down. So that also served for some, that base effect also helped in terms of year-on-year. But for some of them, we also saw that slowdown in terms of a quarter-on-quarter basis, which means that's comparing it to the first quarter of this year. But by and large, it's been positive, and that's also responsible for that positive sentiment that we're seeing in the market in some select stocks.
Now let's look at the telecom sector. What stood out for you there, and what's your outlook?
Okay, thanks. I think very interesting. If we look across both MTN and Airtel Africa, we saw that increase in average revenue per user, what we call Apple, increased by over 30% for both companies. And however, the number of subscribers within the quarter reduced. So looking at the Apple that have increased, it means Nigerians are spending more on the use of either data or voice, and that may be linked to what would say the new work structure, that you have more people working from home, and that's necessitated the use of more voice and data. Now, going specifically into the companies, when you look at MTN, for instance, the top line also grew, increased by about 24% to about 791 billion naira, and the bottom line increased by about 49% to about 141 billion naira. And breaking down the top line, we saw that there was an increase of about 14%, average of about 14% in both voice and data. But interestingly, looking at the revenue from SMS, that increased by over 5 times, which is pointing to the fact that maybe more people are using SMS to to communicate than the normal WhatsApp, because that was a major surprise. Or maybe looking at it based on last year, a lot of people did not use SMS. We have more people at home during the lockdown, and there was no reason for people to exchange messages. So, but by and large, for you look at based on the ratios, EBIT margin and also the PBT margin also improved to about 34% and 24% respectively. Now to Airtel Africa, Nigeria still continue to account for a major part of the business, over 35%, followed by East Africa. Top line also improved, was very impressive. And looking at the bottom line, increased by about 149% and to about $142 million. That's really very positive. And in terms of the margins, they also increased by about to about 20% for the EBIT margin and PBT margin. So by and large, for that sector, it's very interesting. And looking at the outlook expectation, we expect that the demand for voice and data will be sustained for the rest of the year, which means that for investors, they can also position. You look at MTN, it's based on the current price and based on our target price, it's still at a significant discount to our projection. MTN is also paying a dividend of about 2 naira 55 kobo, beg your pardon, per share, and which we feel is also positive. Yield is around, I think, 2%. For Airtel Africa, we're also positive that by the end of the year, their dividend will also be positive. So I think in summary, the telecom sector, you look at it based on a GDP base too, is also benefiting from the business activities and the new structure of the economy.
Okay, let's look at the industrial sector. What do you think characterized that sector?
Okay, thanks. That's mostly when we want to look at it based on GDP classification, building materials. And what we saw that stood out, the three companies that are quoted, you saw Lafarge, Lafarge Cement, Boa Cement, and Dangote Cement. We saw that significant surge in their top line, which we linked to maybe the accumulation or backlog of demand. During the lockdown, a lot of business activities halted, and as a result of that, most of construction activities were halted. But what we're seeing is that a lot of those construction activities is picking up, and that has helped in terms of the demand for its product. We're starting with Dangote Cement that has the highest in terms of EBIT margin and PBT margin of about 40%. And same with Boa Cement, where the EBIT margin, that's earnings before interest and tax margin, is also about 40%. And but compared to Lafarge, the EBIT margin is around 26%. But we believe that for that sector, looking at what they've been able to, based on their performance for the half year, both grew. When you look at across their top line increased significantly by over between 20 to 30%, which is also very impressive. And we believe that construction activities will be sustained for the rest of the year. Yes, we are wary of the third wave of COVID-19 pandemic, but we believe that there would be no significant lockdown. It will be more of public awareness and putting checks and balances in place. So for investors, they looking at the outlook, it's also a sector that they should also pitch their tent. We believe that they will also sustain their impressive dividend payment within that sector, which for us, we believe is also a buy.
And when we look at the banking sector, we saw just a few. Let's take a shot from FBNH half-year results. Do you expect other banks to follow this trend?
Okay, thanks, Chemeze. I look at the two banks that are published so far, FCMB and FBN. They are both holding companies, and we would say the banking sector did start on a very positive note. And looking specifically into FBN, top line was just flat for about 1.7% on a year-on-year basis, but bottom line declined by about 20%. And you also want to look at what's responsible for that poor, what we call poor performance or not too impressive. You would discover that the OPEX increased by over 20%, and that led to the increase in cost to income ratio to about 70%. So when you are looking at it in terms of metrics, the ratio, so First Bank cost to income about 70%, ROE of about 10%. We look at to the likes of GTB, which has a cost to income ratio of less than 40% and ROE of over 20%. It means that there's still a lot that needs to be done in terms of efficiency. There needs to be a way to bring down costs as much as possible. One positive thing that we saw there was the improvement in impairment charges, which we attribute to First Bank's exposure to the upstream sector, which we can also link that to the improvement in oil prices, which would have led to write-backs compared to when we look at it on a year-on-year basis. But I think by and large, there's still a lot that needs to be done. And in terms of expectation for other banks, we believe the top banks, the likes of GT Bank, Zenith, UBA, Access Bank, that customary they pay also pay interim dividend. And sorry, I missed out Stanbic. They also pay interim dividend. We believe that their performance should be positive, both from a top line and bottom line perspectives. Though we expect that, yes, due to cost of doing business that have increased in Nigeria, OPEX may be on the high side, but we are positive, and we believe that on the minimum they would be able to pay the interim dividend that were paid last year. So we still believe that those top banks for investors is also a buy.
And what's your take on the earnings from the oil and gas sector?
Okay, thanks. I think for the oil and gas sector, we have the upstream and the downstream. We can see on a year-on-year basis, the sector on a year-on-year basis have improved significantly. The sector was really beaten as a result of drop in oil prices when you check last year on a year-on-year basis. So speaking to Seplat that operates within the upstream space, we saw that improvement in the top line for Seplat Energy. And you also, when you look at their profit, they've moved from a loss position of about $110 million last year to currently think about $40 million. I've not mixed that up. And we attribute that to the improvement in oil prices, which currently it's around 70, at least above $65 per barrel. And when you look at it within the quarter, there was a significant improvement compared to last year that it tanked to close to about $30 per barrel. Then looking at the OPEX, because we were not too impressed with the bottom line for Seplat, we saw the finance charges rather increased significantly. Seplat raised about $650 million from Eurobond in the last quarter, and part of the proceeds of that, utilization of that fund, they used that to offset their 2023 Eurobond of about $350 million, and about $250 million was also used to pay for some of their drawings that they made before they raised the funds. So we believe over time the huge finance costs should normalize, and if oil price is also sustained at that level. And also to note that Seplat sustained its new dividend policy, quarterly dividend policy, also paid 25 cents, and when you convert that to naira, that's over 100 naira per share. So we believe that is also positive, and investors that are looking for cash flow would also try to pitch their tent in that stock.
And how do you think these earnings will shape trading activities for the week and, of course, into the new month?
Okay, thanks. Based on some of the companies that I've analyzed so far, you would agree with me that we'll have more positive earnings than negative earnings, and we believe that would shape the direction in the market. We expect more positive sentiment, and we also know when you look at the culture or the habit of Nigerian investors, they buy stocks because of dividend. We know a lot of companies also declare interim dividend, and we've been seeing early bird positioning. We expect that some of the banks that we're still expecting, we believe that there will still be strong interest in those banks. And for those that have declared dividend, the likes of Seplat, likes of MTN, we would also see investors also taking position in those stocks. So for the week, we believe that we imagine market will still gain positive, but could be specific to few stocks that have positive expectation in terms of numbers. And for the rest of the year, we would tie our expectation or outlook to the direction of fixed income rates in the fixed income market. Yes, we expect that we may see some moderations. Liquidity will be higher within this quarter, and that would also impact on the direction of yields, which would also be positive for the equities market.
All right, thank you very much for your time, Ayodiji Evo. We do appreciate it.
Thanks for having me.
And despite those impressive results, sentiments turned bearish at the equities market last week as profit-taking activities dominated the market performance throughout. But first, let's get a sense of how the FX market closed last week after that announcement by the central bank to stop allocating forex to BDCs. Hey, Anete.
Good morning, Chimi. May I say happy new month, because we're in a new month, the 2nd of August. And of course, the year is counting, just as we're counting everything. Okay. So now let me bring you up to speed with what happened last week at the fixed income market, or the FX to be precise. It was a positive picture in terms of the total turnover of FX transactions there. It was a 98.43% in contrast to what we had the previous week. The total there is $902.45 million. That's the value of transactions. And this is coming just within the week when the Central Bank's Monetary Policy Committee announced that it would be suspending or discontinuing its sales of forex to bureau de change operators. So now it was actually a positive impact. Of course, that's because there was also the weekly FX supply by the central bank to the banks. Now, also, when you take a look at the investors and exporters FX market, the total value of transactions in dollars there was up by 80.24% at nearly 600 million units, nearly $600 million. At the NAFEX, it was up slightly, 0.02%. That's just when you take a look at the contrast between the two figures there. But for the BDC, of course, that's the signature of all eyes. It was down by 2.40% last week, in contrast to what it performed the week before. And it closed that week at 512 naira to the dollar. Then let's flip over to the FX, to the fixed income market. It was bullish sentiments there. Total number of deals, 76. And then also at the treasury bills market, it was also a bullish sentiment. So, and that's because some investors were cherry picking into instruments at the mid and long segments of the curve. So that's why we had a bullish sentiments there, which is coming despite lower demand by investors. But to bring us up to speed with what happened within the entire 5 trading sessions last week, let's talk to Dimeji Obasa, who is a fixed income dealer at Axis Bank. Thank you for joining us, Dimeji.
Thank you very much for having me.
Was quite a lot of activities at the fixed income and the FX market last week. So can you give us an insight of what happened? We're in a new week, but just bring us up to speed with what happened last week.
Okay, last week being the last week of the month, I'll just give some of the highlights from the week. In the FX market, we saw a 44 kobo depreciation for the month in the NAFEX rates. closed at 411 naira 10 kobo, while there was a marginal appreciation in the I&E rate by 6 kobo to close at 411 naira 44 kobo, as the CBN maintained its intervention in the market for foreign portfolio investors. The market turnover in the I&E window was about 196 million. It declined by 196 million, and it closed for the whole month at $2.8 billion. The CBN conducted 2 retail auctions where the minimum spot rate was treated by about 4 naira to close at 436 naira. The CBN also maintained its intervention for the SME and invisible transactions. In the fixed income market, for the month of July, we saw mixed sentiment across the NCB and the OMO curves. However, there was significant demand for treasury bill securities at both the primary and secondary markets. For the month, we had 2 treasury bill auctions where a total of 327 billion was on offer. Both auctions were oversubscribed, and the DMO sold about 415 billion, with stop rates at the 91 and 182 day maturity remaining stable at 2.5 and 3.5% respectively, while we saw the stop rate for the 354 day bill decline by 95 basis points to close at the last auction at 8.2%. For bonds, we saw cautious trading across the curve, with investors opting to fill their demand at the bond auction, where a total of 150 billion was on offer across the 2028, 2036, and 2050 maturities. The bond auction was oversubscribed, with the bulk of the demand skewed toward the 2050 maturity. Stop rates at the auction were 12.35, 13.15, and 13.25 for the 2028, 2036, and 2050 maturities respectively.
Okay.
It's also what it means that there was an MCC meeting last week where the committee maintained parameters. The NPR rate was held at 11.5% with the abstention corridor of plus 100 basis points and minus 700 basis points around the NPR. The CRR and BT ratios were also maintained at 27.5 and 30% respectively.
Dimeji.
For most of the month, we expect the CBN to announce firm plans to clear the backlog of FX demand following their recent halt on FX sales to PDC operators. We are likely to see some sort of intervention in the I&E market by the CBN. We also expect the CBN to continue its market intervention for investors as well as SME and invisible transactions.
Sorry, thank you,
Dimeji. Market, we expect the DMO to conduct 2 entities.
Hello, Dimeji, can you hear me?
To roll over.
Hello, Dimeji, can you hear me?
Yes, I can.
Yeah. Okay, sorry. Thank you. I know you have quite a lot to tell us, but time is not really our friend, so we just have to cut you. But we thank you for giving us that outlook of what to expect from the fixed income and the FX market this week. So thank you for that analysis. So that was Dimeji Obasa, who is a fixed income trader at Access Bank. So now let's move. The red that you see behind us here is the equities market. Of course, it was down by 0.31%. Of course, we started the last trading week of July positive, but 3 days in between, it was negative, massive sell pressure on mid-cap and some high-value stocks. And then, of course, we closed that last trading day of the week positive, but cumulative, it was 0.21% down. And then, of course, the value was 64 billion naira. Take a look at the sectoral performance. It was mixed, but mostly negative, particularly on the banking, industrial, and insurance sectors of the mark of the NGX. And then, of course, the total value, volume, and deals were in the green. Moving over to the unlisted securities market, it was also down. I think we lost about nearly 2 billion naira, 1.93 billion. That was what it printed in loss. Of course, as well as the volume of transactions there was not too much, 1.83, value 12.81, and the total number of deals just a little over 3,300. So that's what happened at the unlisted securities market as at July the 30th. And then, of course, we're looking out for how it's going to start the new day, the new month today. So we'll keep our eyes open for that and what investors are likely to, where they're going to take their positions for each of the markets.
And we'll keep an eye on those markets and see how things turn out in this new month of August. We take another break, and when we come back, we do an opening call to London. Just stay with us. And for markets in London, let's talk to Juliana. Good morning, Juliana. Well, starting off the day with corporate earnings from banking giant HSBC, the UK-based bank says its first half profit has more than doubled. What's most striking for you about HSBC's results?
Good morning, Chimese. Well, yeah, these are a good set of decent results for Q2. Q2 results that have come in from HSBC, Europe's largest lender, pretty much following the trajectory we saw last week from NatWest and Barclays. Their profits have gone well ahead of market expectations of $3.1 billion. It's come in at $5.1 billion. Revenue slightly down from the same period last year, from $13.7 billion to $12.9 billion. But this is good. One of the reasons why, of course, is because we are seeing global growth across the world. So the bank has reported growth in all of their divisions, but also those provisions. It's been a pretty tumultuous 18 months for banks, especially if you're based in the UK. Interest rates are at that historic low of 0.1%. And because of the pandemic, lots of banks were putting aside provisions for bad debt. So already this year, HSBC have been able to cancel $700 million worth of bad debt. Their restructuring efforts that have been put in place by their CEO, Noel Quinn, are starting to reap the rewards. Their US wealth division is going to be wound down. There have been thousands of job cuts, and they're also going to cancel their French retail banking division. So yes, it's good for HSBC. Last year, their share price was down 45%, but it is starting to climb back up.
And the pressure is building on the Prime Minister to radically redraw restrictions on foreign travel next week in time for the final weeks of the summer holidays. Now, the Chancellor, Rishi Sunak, had written to the Prime Minister demanding greater relaxation of travel rules to have summer holidays, or rather to save summer holidays. How do you see this playing out?
Gosh, yes, I'll have to look into my crystal ball if I had one. Nobody knows. That's the big issue. But the headlines here in the UK are definitely SOS, which is Save Our Summer. The traffic light system that came into play a few weeks ago now is causing so much confusion and complications. It started with green, amber, red. Now we've got green watch lists, and potentially, which is causing the firestorm at the moment, is this amber watch list. So currently, at the moment, if I am up to date with the information from the Transport Secretary, Grant Shapps, if you are double vaccinated, you don't have to quarantine on return if you go to an amber listed holiday. However, there are suggestions and rumours that the Prime Minister is now mulling over potentially having an amber watch list new option, which basically means if you go to an amber watch country, and apparently Spain, very popular tourist destination, Italy and Greece could be on there, then at any moment's notice, the British government could put that holiday destination on the red list. And the red list would mean you have a very, very costly return into the UK, as well as lost earnings, because you would have to quarantine in a hotel for 10 nights, and that costs over £1,800 per person. Most people in this country that go on holiday in the summer are going with 2.5 children plus their partner. So this is very, very concerning. As you said, Chancellor Rishi Sunak has written to the Prime Minister, reportedly, we're not sure if this is true, saying that this would be an absolute mistake and that the travel industry is already beleaguered. We had results from Ryanair, from IAG last week. The results were bad, but they're all hoping that the summer season, the most important season of the aviation calendar, could potentially save some of their lost earnings. If this is true, this amber watch list is true, we'll find out on Thursday when Grant Shapps makes that announcement. Then there are fears that we'll be way behind our international competitors. So yes, it's all very, very confusing at the moment. But, you know, ministers have been saying, you know, before you book a holiday, you must be sure that you can pay for the consequences of, you know, trying to enjoy your summer.
Well, it's the first trading day for the week and the new month. How has the market started off this morning, and what's on the radar for investors this week, aside from the BOE's meeting?
Yeah, well, it's sunny in London today, and when it's sunny, that's usually reflected in everything, and it's been reflected in the markets today. They're up about 70 points, even though there is still confusion amongst the travel sector. It is the travel-related stocks that are leading the risers. So we've got the likes of IAG, the BA parent owner. Their shares are up 4.8%. Rolls-Royce, the aero engine maker, their shares are up by about 4.5%. And we've also got some of the retailers doing well. Next, JD Sports, their shares are all up between 2% and 3.5%. Aside the Bank of England, well, it's all about the Bank of England, to be honest, Chimese. They are going to be meeting the Monetary Policy Committee on Thursday to talk about quantitative easing and inflation. Most analysts are saying everything is going to remain the same, but it's the minutes, crucially, that everybody will be looking at. And aside from that, we do have PMI data coming in. In fact, I believe one of them should have been in now, I believe, for manufacturing. So hopefully at BizInc, we'll be able to discuss that.
Absolutely. We're looking forward to get that PMI data later today on Business Incorporated. And of course, we look forward to the BOE's meeting. Thank you, Juliana.
Thanks, Jimmy.
And that's a wrap on the program. Don't forget to join us by 1:30 on Business Incorporated for more updates and developments in the world of business. I'm Chimeze Obi Iwago.